Welcome to Altus Insights podcast series with Ray and Marlon, hosted by me, Avi. This podcast will cover monthly market updates and construction cost impacts across major markets in Canada.
Hi, thank you for joining our monthly Altus Insights podcast. Marlon today unfortunately can't join this session. This session we're going to talk about 2022 in review and what we sort of anticipate for 2023. And 2022 was sort of a turbulent, not turbulent, but interesting year with, we were still seeing a 9% increase of investment activity over 2021, from 55.8 billion last year to about 60.8 billion, but activity is definitely tapering off. The office vacancy rates continue to climb with slow return to the office. Industrial, multifamily, residential continues to experience very low vacancy rates and continue to increase in rents. And of course, retail continues to evolve. To join me in today's discussion, I have two very esteemed and well-respected guests. Combined, I guess, with the three of us, the scary part is over 60 years of experience. Sad. And we have Wendy Waters, who's Vice President, Research Services and Strategy at GWL Realty Advisors, and as well as Phil Stone, Principal Head of Canadian Research at BentallGreenOak. So I'll give you guys each a few minutes before we get into the questions to talk a little bit about yourself and a bit of an introduction, as well as a little bit something about your company. Wendy, you want to start?
Sure. So I've been at GWL for 16 years, leading the research group and with various titles within that. My background, prior to this, I was at Avison Young, leading research there. And prior to that, I was actually in the .com. And then before that, I did a PhD in economic history, specializing in 20th century economic growth and development. So it's a reasonably good background for what I'm doing now, which is, understanding what drives real estate performance. Is a lot comes back to the economy, demography. It's all about how people experience life, use real estate as part of that. GWL Realty Advisors, for those of you who don't know, we manage the real estate assets of institutions and pensions. We have approximately 17 billion under management in Canada, another 1.2 billion in the United States. So this is office, industrial, retail, and multi-family residential. We do development, we do property management, asset management, portfolio management, so fully vertically integrated. I think that's primarily about it, unless you have any further questions, Ray.
No. Phil?
Great. Thanks, Ray. Thanks for having me on the podcast. This will be a fun discussion. As Ray mentioned, I'm Principal and Head of Canadian Research at BentallGreenOak. So BentallGreenOak is a global real estate investment manager, deploying strategies across the risk spectrum in both the debt and the equity side of the business. We are now a little over $80 billion US dollars in assets under management. And I've been in this role for about 5 or 6 years now, coming on 6. I've been at BentallGreenOak and previously Sun Life now, who owns a majority share of BentallGreenOak, for about 10 years now. I come at it from a little bit of a different perspective, research that is, in that I've been, I would say, more of a real estate practitioner in my prior roles across various investment management roles, through both some private organizations and publicly traded a REIT as well prior to joining Sun Life. So that's a little bit about me, and looking forward to the ensuing discussion.
Great. Hoping for a little bit of debate discussion. So we're going to start off with the capital markets, and we're going to intertwine the market fundamentals as we go through it. But we're seeing investment activity starting to come down a little bit. Can we go through the some of your perspectives of what do you think is happening with the market right now? Why are we seeing this bit of a slowdown? And what are your thoughts with interest rates or inflation? So we'll throw it open from there. Wendy, you want to start with your perspective on the capital markets?
Well, I think our perspective right now, it's slowing down. There's a lot of price discovery going on. So there's, the bid-ask spread is wide in some cases. So it's figuring out what the right return on the cash flow should be. That in most of the real estate asset classes, we're going to talk about office in a minute. That might be the slight outlier. The market fundamentals are still really strong, especially industrial and multifamily, but we also do grocery anchored retail. That is a strong asset class. And so the NOI is holding up. In fact, in many cases growing. So the question is what, are investors prepared to pay for that income stream? And that's the price discovery on the cap rates that we're noticing. And it's probably, as long as there's a lot of some volatility in interest rates and inflation, it's going to take a little while for that to sort itself out.
Yeah, no, 100%. I mean, it's really been a cost of funds question combined with uncertainty. So those two factors, I think investors are on pause for the moment. And I think until there's further clarity on both inflation, which is going to lead where interest rates go, I think it's going to be pretty tepid for the next, call it 6 to 9 months. I won't get into too many specifics on time frame because again, there's a lot of uncertainty out there, both from an economic perspective and an interest rate perspective. I think this past year is really a tale of two markets. Ray, you mentioned those transaction volumes off the top. I think, we're going to end up 2022 will go down probably as the second largest year in terms of transaction volume on record, but it's really been basically since the second half of the year, transaction activity has really ground to a halt. And that's really across all buyer profiles. Institutional investors really hamstrung by the denominator effect, as you've had both bond and equity prices really come off. I mean, this will, when you look at a 60-40 portfolio, this is on pace now for the second worst performing year in the last 100 years. And so, real estate's actually been a pretty good place to be. When you look at the performance of real estate, if you look at the MSCI index and how well it's performed to date, but of course, real estate is lagging, right? And so you get the combination of that price discovery plus appraisal valuation lag to a certain extent, and we're going to start to see that repricing continue into next year. And I think we have to kind of go through that. And I think it's, to Wendy's point, operating fundamentals have been exceptionally strong. Again, we'll talk about it, but for some of the secular changes in office and retail, but all else, things are in pretty good shape. And so it's really a repricing exercise based on cost of funds.
Yeah, the earlier comment that we're only up 9% and compared to a year ago, and 2021 is an anomaly because it's sort of like 1.5 years of investment activity in one, just because of a lot of the deals that were pushed off in 2020. And to a certain extent, the first quarter of 2022 was reflective of that overlap of 2021 activity that bled into this year. And up until mid-year, we're up 45% compared to a year ago. We're definitely starting to see some of the deals and some of the complexities just to get some of these deals over the finish line. Now, with the interest rates, and I think we all sort of predicted that we're going to see an increase in interest rates this year, and with inflation being that sort of obstacle or that goal to bring it in line to a certain extent. Now, has any of those sort of factors and what's happening with the market fundamentals adjusted or impacted any of your recommendations to with respect to where the market's going? So looking at the beginning of the year to where we're at now, have you changed your thoughts about where the market is moving towards? I
can start. I think because market fundamentals are so strong in certain asset types, I would say not in a big way. Obviously, we're always taking a look at what the structural if there's any structural changes happening, what are the cyclical factors affecting our real estate markets. And certainly we've hit into some cyclical changes with higher interest rates, higher inflation, and we're figuring out what is structural and what is cyclical from that. And then there'll be maybe some recommendations on that. But generally, I would say that it doesn't affect that. It affects maybe ability to execute, or it affects timing, as opposed to what our outlook is.
Yeah, I would say, I don't think much has changed since the beginning. I think not that we, I think what I would say is I think you want to stick with when you're looking at property sectors, you want to be in those sectors where you've got rent growth and NOI growth to offset those inflationary pressures. And I think it's been quite evident in some of the market activity that we've seen, where those more inflation sensitive sectors are getting hit. But even in let's say, for example, industrial, where pricing has been quite strong, rent growth has been quite strong. We've seen what limited transactions have transpired. There's a clear dichotomy between those with rent rolls, with a longer term weighted average lease term that are, call it, 5 to 10 years, that don't have significant annual inflation bumps. Where they're below inflation. We've seen more repricing on those assets than we have for shorter lease terms. And the folks on my transactions team put together a fantastic slide just the other day, actually, looking at pricing and they looked at more or less same stores you can get in this market where there is limited transactions. But when we look at pre-interest rate hike and post-interest rate hike, even for those high quality, large box, big box distribution centers, you were in the low 3 cap rate for some of those assets. We now see kind of trading in the mid 4s. So some significant price correction, and that's largely Walt driven. And so you've got to be able to get at an income stream that will provide you protection against rising costs.
Okay. Wendy, you did an article with the National Post back in July, End of the Office, Not So Fast, GWL Realty Advisors. So you're a strong proponent of where the office market, office product is and how we interact with it. Do you care to sort of comment on some of the highlights with that article on your stance?
Yeah, well, in terms of office, we see us in somewhat of just another cycle of office where, typically a lot of new construction happens towards the end of a growth cycle. And then when it opens, we tend to be in a bit of a downturn. And whatever causes the downturn is different every time. This time it was more of a virus and then some global geopolitical events, but it's the same effect. So there's a bit of a downturn, but we still see office as having a strong future. Employees are coming back. We're seeing back to 4 days a week, which means people need desks. They need space to work. We've seen tremendous growth in office-oriented employment over the last 5 years, and including right through the pandemic. And there's been a little bit of a pullback with some of the tech companies more recently, but that is not even taking them back in most cases to their 2019 employment levels. It's shedding some people added in anticipation of growth during the pandemic. So we're optimistic on office for the long-term future of office generally for these reasons that we have growth, we have a need for people to connect, to collaborate. There's a lot of companies now talking about how they feel productivity, broadly defined, has been impacted by people working remotely. It's not just about how many spreadsheets you fill out in a day, but it's how you get mentored or you provide mentoring formally and informally. It's those quick collisions where you learn something in the hallway. It's the quick connections with your team to say, hey, who's got this file, or does anyone know where this is? Does anyone know the answer to this question? And, if you had to do 4 Teams calls to find the answer to that, it would waste 2 hours of your day. And you can sometimes solve it in the office in 5 minutes. So we're optimistic on office, medium term, longer term. We are in, a sort of a down part of the cycle in some of the markets, mostly from new supply. but also companies experimenting with what the future office space they need is. Toronto obviously is in a new supply cycle with a lot of companies looking at consolidating, changing up how they used office space pre-pandemic, and it's being implemented through and now as they're moving into new office space. And the bigger the company, the more consolidation potential there is. Smaller office markets, a little bit less because you still need your kitchen and your meeting rooms. And, if you're only a one floor tenant, if if 10% of your workforce goes home or 20% goes home, it's hard to shed 2,000 square feet. It's easy to shed 20,000 square feet. So depending on the market, we're seeing a little bit more impact, say in Toronto than in Vancouver. Calgary, pleasantly surprised that there's starting to be some, modest activity and absorption there. And certainly not modest compared to what it's been, quite strong compared to what it's been, but, modest maybe compared to some longer term averages across the country.
Nope.
Yeah, no, I think, over the longer term, I think just given the nature of the investors, the developers here in the Canadian markets who are very prudent, I think we have some supply challenges in the near term. Certainly, I think, Vancouver and Toronto most prominently in downtown markets. But I think over the longer term, things are going to be, just fine in office. But I think over the near to medium term, there's going to be some real challenges. If you look at Canadian office markets in comparison to North American markets, Vancouver, Toronto, still some of the lowest vacancy rates in all of North America, despite the fact that they've increased and, are continuing to rise. I think Vancouver's fared much better than Toronto has over the past year and a half or so. But I think there's going to be some challenges. I think it'll be interesting to see how many of the big tech layoffs are impacting Canadian jobs. I think it's been difficult to kind of read through the headlines and sort through just how much. But we're getting from our tenant base, we're actually getting contrasting comments and actually some tech tenants actually looking for more space despite some of these headwinds, which you would not think would be the case at this moment in time, but it is. So it's not a one size fits all. And certainly, as Wendy mentioned, when it comes to occupiers and how they want to utilize their space, it's definitely not a one size fits all, and it varies even within a firm and departments. There was some encouraging news article last week from the federal government, nothing concrete yet, but it sounds like they're about to make an announcement on the Treasury Board coming out with some guidance. We'll see how prescriptive it is on federal employees getting back to the office. Whether they'll specify how many days that is and what days potentially, but I think there's been a bit of a shift there in sentiment. And, for a lot of the reasons Wendy mentioned, there's benefits to being back in the office. But yeah, I think, that sector, just from a pricing perspective, I think has been mispriced for a long time, particularly with respect to the CapEx that's required to actually position a building and maintain its competitiveness over time. And so I think, both equity participants, but importantly, on the debt side of things, lenders are really looking at how they're underwriting office going forward. And I think that's going to have an impact on both the liquidity of assets and the pricing ultimately over the next couple of years.
Hey, Phil, what do you mean by mispriced? Is that too high or too low?
Too high. I think a lot of, again, and it's a large function of cheap capital, but I think the operating and capital requirements that need to go into a building to make it competitive against a growing new supply of product, I think was, underwritten in the buying process and in valuations. I don't think there was enough capital carried. And so therefore, I think those values, may have, and this is a market phenomenon. This isn't specific to any one country, even, for example. But so I think there is some repricing to happen in office, and we've seen it already. I mean, you can see it in the public markets in both Canada and the U.S. Obviously, a little bit more leverage than, say, the institutional market when you look at the price declines that we've seen in office, and say, for example, the if you look at the MSCI property index as a proxy for private market assets, values are maybe off 10 to 12%, but kind of slowly trickling down. And I expect that they'll come off a little bit further in 2023 as well.
Yeah, there's been a lot of research on whether office has been, to Phil's point, sort of underwritten or maybe slightly, overpriced compared to what the CapEx is going to be required. And this was being talked about before the pandemic. So it's another one of these situations where the pandemic put a magnifying glass on a trend that was already there, or an issue that was already there. And, the other thing I was going to say is I think we've got some office buildings, well amenitized, generally newer, but they could be a very nicely refurbished older product, have been doing well, and where the employees are back. I think Gensler had some data last week or 2 weeks ago at the real estate forum. That was something like in some of the buildings they're actively involved with 90% are back in well amenitized office, and maybe only 10 to 15% back in some of the older product. So that tells you where the demand is, and so that repricing may be less of an impact on the well amenitized buildings, and maybe it's more on some of the buildings that are a little bit more challenged in that way in terms of attracting tenants.
Yeah, I was going to ask you that question in regards to with ESG, and we have to talk about ESGs. Do you think that's going to add more to this, and as well as the amenities themselves? The argument is that it's a little bit more targeted, especially with sort of the younger workforce that are looking for that interaction, looking for that great coffee shop. Do you think that sort of plays into possibly higher rents? But on the ESG component, do you think that's going to contribute to sort of more costly changes with some of the sort of particular older product?
Well, I think we've got, everyone's got both climate resilience and a push towards carbon neutrality that we have to manage over, well, let's say the next decade plus, or next few years as you plan capital on buildings. So it does play in. So far, I think we're not getting that many tenants that are coming right out and saying, or a growing number saying we have to be in a green building, but it's definitely out there as a key consideration. Or maybe they want to be in a green building, but it doesn't need to be a net zero building. I guess I should rephrase that. But it's definitely, I think it's coming. You think some of our major tenants, these tech companies, have made net zero pledges. So I suspect I do anticipate that we are going to see that, and that is just part of the capital plans that our teams work on for any building, includes climate and carbon considerations going forward.
Yeah, for sure. No, I think that flight to quality story is just going to become more and more pronounced, and it's both an occupier and an investor flight to quality. And we've seen it today. We've looked, like, when you look at absorption data and you stratify it by year of construction, and we've looked at it even breaking up the last decade from 2015 onward. It's positive by a lot in that 2015 and newer category, and it's negative absorption for basically all else. And so, yeah, I think that's probably going to continue for some time.
What do you guys consider as a sort of amenitized building? What do you think are the basic needs to meet the that would attract certain companies?
Well, I would look to CBRE had a good occupier survey out. I think it was mid-year, but I think among the few things that they noted as top of the list were like shared meeting spaces, flexible open space, flexible office space. So thinking about co-working and that as an amenity within your building to a certain extent. I think connected tech and building apps, touchless technology, things like that. But also just, again, with the pandemic really shone a light on indoor air quality, for example. But it's as much about in the building itself as it is the locational amenities and the surrounding retail and service amenities as well. Yeah, I might add, certainly, indoor air, but also amount of light. So some of the older buildings sometimes don't have as great a light
So employees really wanting, and that access to daylight, that was a trend before the pandemic. So there tends to be fewer perimeter offices by the window and more access to that natural light for everyone. Outdoor space is definitely a key one for any new construction. Tends to have some outdoor spaces for the tenants to use. Dog and pet friendly is another one that's relatively new, but it's, you get tenants that say that's a requirement to come into the building. So Vancouver Centre 2, which is our new office building in Vancouver, is pet friendly. The anchor tenant, that was a condition, and we were quite happy to give that a try. So and we think we've tried it in some other buildings as well, more on the multi-res side, but so we have some experience with that. The other one is fitness and end of trip are the other big ones that a lot of tenants are asking for across the country. So end of trip for people who want to cycle commute or jog or whatever. Also for people who might want to go for a run at lunchtime, that's very popular. Safe places to park bikes is big. And then of course a fitness center that's a nice high quality fitness center. It's no longer that dark dingy room in off the parking garage or in the basement. The trend is now brighter above ground and a much higher quality fitness center.
Wendy, for your building, is there a maximum number of dogs or cats you can have within the space, or is it unlimited?
Good question. And I do not know the answer to that. Some of that may be from the tenants themselves as to figuring out how many dogs they want in their spaces. But yeah, there are some rules around that, but also the tenants tend to make their own rules in terms of behavior, how many, and so forth.
Yeah, Altus is now pet friendly, aren't they?
Well, it's that's why another reason why I was asking, because I think we were restricted, but okay. They did allow us for the 1 day of unlimited dogs. So we very much appreciated that 1 day, and we're hoping to squeeze a few more days going forward.
I was going to say, is there an app you have to log your dog into to reserve a space? We haven't gone down that path.
You're giving Wendy some ideas, and she's going to put in some recommendations here. So I'm a little bit afraid at this point. I love having our dog here. Thank you for joining us for part 1 of our 2022 CRE Market in Review miniseries. In our next episode, we'll continue the conversation with Wendy and Phil by reviewing Canada's industrial and multi-residential market.